Our next discussion will stay on financing. Now, please welcome Ms. Dandan YE, Executive Director and Head of Healthcare and Syndication at the Shanghai Innovation Bank. She'll be talking about innovative financing for clinical medical startups accelerating healthcare breakthroughs.
Thank you very much. Distinguished guests and everyone, good morning. It's my privilege to be here representing Shanghai Innovation Bank and to share with you some of the innovative financing tools that hopefully could help startups here and also increase maybe the possibility of your success. For some of you who may not be familiar with us, we previously known as SPD Silicon Valley Bank. So we are the joint venture between Shanghai Pudong Development Bank and Silicon Valley Bank back in 2012. That was kind of a phase one. We tried to bring the whole Silicon Valley technology lending philosophy from US to China. And back then we worked with a lot of top US dollar VC funds. And then until China started to launch the innovation board, we entered into our phase 2.0. We start to embrace more RMB VC funds, and also our clients transition more from TMT to hardcore technology companies. And today we're more like phase 3.0. We changed our name to Shanghai Innovation Bank in 2024. And that shows we're going to continue to dedicate into the whole innovation economy in China. Despite of all the transition, what haven't been changed for the past 13 years is our several key business models. The first one is our dedication into the whole innovation economy in China. We currently divided whole bank portfolios into 5 sectors. The first is digital transformation, like AIGC, SaaS software companies. The second are advanced manufacturing, like robotics, new materials. The third is semiconductor. The third is life science and healthcare. The last is the new energy. So for the past 13 years, we didn't do anything outside of this range, like no real estate, no infrastructure, no individual business. So that's why a lot of people would confuse us with, with the VC firms. But actually, the second biggest group of our clients are actually VC clients. We've been working with more than 400 VC firms, and the business expands from their fundraising to investments to even exit strategy all along. So these 2 slides describe the basically client profiles of our bank, which are VC firms and actually the innovation companies they're backed. So now let's talk a little bit about our healthcare and life science industry. So right now, the whole bank portfolios, 30% of the bank portfolios are actually coming from the healthcare and life science. We started this sector focus actually quite long ago, back in 2013. So this chart represents a very small proportion of our clients, but quite representative. If you look at the horizontal line, which is the first year we worked with those portfolios, and the horizontal line represents actual stage they were at. Some of them already grow into the market leaders, but we actually started the relationship with them when they were very young, and most of them are at Series A stage. Some are even at C stage. And we typically grow with them along the way. The second feature, if you look at the colors, so basically we divided our healthcare portfolio into 4 subsectors, respectively biotech, medical service, including CRO, CDMO, AI, healthcare company, and also medical device subsector. Last is the diagnostic and lab tools. So each year we are onboarding the new clients from every of these subsectors, despite of the popularity in the market. So right now we have a very diversified healthcare portfolio within the bank. The last treats is actually every year we have portfolio exits in public market or being acquired. So we are quite proud of that, and we think we have a quite good, successful exit rate as a bank. So along the way, a lot of people ask, because as a bank, you're doing a lot of high risk things, you're serving a lot of startups, how come you keep a very high successful rate? Is there any secret weapon? Well, that all comes to our very unique credit management model. I won't elaborate all of them today, but only two particular models that we're focused on. The first one is the professional industry research. The second is about the unique evaluation model that we have. So about the industry research, as a bank, we spend a lot of time look at the investments data. We try to get the capital consensus on a particular healthcare company that the investors are looking at. The evaluation model is more about the enterprise value, because most of the company that we serve, they have no revenue, they have no cash flow at all. So it's more about technology, a lot of things Scarlett just mentioned just now, the team, and also the business model that they're focused on. And also a very unique thing is how we match the real company risks with a bank products that we have, which I'm going to talk about later. So a little bit about industry, and also Scarlett mentioned that just now. But this chart is a little bit different. It's because it's fully focused on the China investment, healthcare investment in the past 5 years, which very similarly, we seen the market hits its peak in 2021, and it cools down and bottom out in 2023. We didn't see a very strong rebound in 2024, but slightly getting back, but still not even half of the peak period. In 2025 first half, we saw a little slight down compare, the first half of 2024, but we see a very active investment in Q3 and Q4 of this year, because of the very booming public market, especially in Hong Kong stock market. So we foresee the number of 2025 may be slightly higher or probably flat with 2024, but the whole deal amount might be exceed 2024 level because of several huge pre-IPO fundraising we've seen in the market. Well, if you look at the different healthcare sectors that we are focusing on, from 2020 to 2023, biopharma, biotech is the leading sector all the way. However, since 2024, medical device actually is picking up, and right now it's actually the most popular sectors for VC funds in China, which I think is a good news for a lot of companies sitting here. I think the trend is because the VC funds are getting more conservative, and they want to see more company with cash flow. So medical device companies more easier to get the CFDA approval and get the products launched and see the cash flow more earlier. Okay, so this is the similar statistics that we've seen on the other side of the world, which in the US and European market. Similarly, we could see it's also hits the peak in 2021. but the different from China market is actually had a very, very strong rebound in 2024. The trend continued actually in Q1 of 2025, but in Q2, investments was suddenly down for 20% compared with the Q1 number. So the first half actually dropped compared with 2024, the first half. And if you look at the sectors, which also slightly different from the China, the biotech is always the leading sector for all the past few years. And the sectors comes after actually health tech, which was driven by the AI concept and also the remote diagnosis after the COVID period. And the other thing I didn't show in this chart, but we also noticed is about the fundraising of healthcare-focused fund. Actually, 2025 is a big drop-off of the VC fundraising. The drop probably would be 50% or even 60% drop. That is because of the whole uncertainties on macroeconomy environment, and also because of the tariff and everything. A lot of LPs decide to hold their deployment in life science and healthcare, and probably going to delay into 2026. So that leads to a very critical question is for the companies who are raising equity at this moment. There are going to be limited dry powder in the market in 2026. But what can we do if we, continues to need the liquidity, need to raise additional equity? One other financing tools that you could consider is really the bank debts. So now look at the whole life cycle and how company could use a bank debt along the way. Usually from the 0 to 1 stage, if the company is on the R&D stage, no product, no revenue yet, we think there's very limited banking product that you could choose, and we think the proper debt tool would be venture debt. And that reflects the venture risks the company are taking at that moment. But when a company goes to 1 to 10 and has the product launched, but yet not to reach the mass production, there were more products that you could choose, including venture debt and all the others like revolving lines or asset-backed financings. But if you are like 10 to 100, you being the mature company, you have the very stable cash flow. There are much more banking products that you could choose, like the cash flow lendings, the syndications, that many loans, etc. But today we're more focused on for startup and how you could use this venture debt for your early stage. Well, I've been talking to like thousands of founders until today. A lot of people may heard of venture debt, but most of the time the power of venture debt was underestimated or sometimes misunderstood. I took an easy way. I asked the AI what is venture debt, and it gives me a very accurate actually definition. I won't go through all that, but some key takeaways. So first of all, venture debt is a very tailor-made product. I've been issued thousands of term sheets of venture debt, but I dare to say none of them look the same. It was really tailor-made for each startup, have different debt terms. Actually, it's not like a product 1, 2, 3 and put you into that different products. It's really tailor-made. And second, the venture debt is definitely underwritten without a traditional repayment source because most of the companies has no cash flow or revenue. And the third is very critical. It is about venture debt is not a supplement of equity. It's not replaceable. It's more. It's a supplement of equity. It's not a replacement of. Very important. I hope I don't bore you as in the financial class, but I have to show you this chart, and it indicates how you could use venture debt in a more easier way. So if you look at the first of all the horizontal the vertical line, if it represents the cash in hand, which means the liquidity of the company. And if you look at the horizontal line, which means with the cash in hand, how many months you have based on the burn rates, right? So internally, we call this cash runway. So for a startup, let's say after Series A round or the seed round, it only has 12 months of runway. But when let's say you have only 6 months of runway, you need additional liquidity. However, you didn't really meet a milestone yet. So if you start to raise equity at that moment, it's going to be extremely expensive because you don't see a valuation pickup. But you're confident that you're going to hit a milestone probably within 3 months. So that is a good moment that you reach out and considering a venture debt to further extend your runway for another 6 months without any dilution to your equity. And within that 6 months, you hit your milestone and you reach the tipping point of your valuation, and within the use up your runway, you could raise an equity round at a much higher valuation. So this is the most simple way how could a venture debt works for a startup. It extends your life cycle. It even extends your runway along the term. So to summarize the value of a venture debt, so first of all, it extends the runway prior to the next round. And the second, it supports the working capital to accelerate your medical breakthrough or milestone. And also, it gives you the access to capital at an early stage. Sometimes for a startup, it's good to, gain some bank credibility at the beginning. It's easier for you to get a sizable large loans later. And also definitely most critical for founders, it reduces the average cost of capital and minimize your dilution at the earlier stage. The last one that is interesting is usually we put some financial covenants during the venture debt, and a lot of investors like to, look at these covenants. It's like sometimes performance covenants or liquidity covenants. So it's on the other side to monitor the company if it's going on the right track along the way. I won't spend time on this, which means it shows a growth stage company could also use venture debt. So this is kind of a real case to show you how we support a company from a pre-A round to its pre-IPO stage, within a different type of, banking products. So this is actually a medical device company. We got to know them at their Series A round. And back then, their product was, at the clinical trial. It didn't get the CFDA approval, but very soon. But they kind of used up their cash, and they came to us and getting a venture debt at that moment. And they used that to expand the team, continue the R&D investment, and they get the CFD approval very shortly. And then they finished the Series B round, after getting the CFD approval with a huge valuation pickup. And then after the Series B round, they came to us again, and we increased the debt size to almost double it. And they used our debt to build up their marketing team. And actually, eventually, the marketing cost was much higher than they expected. So we worked very well with their Series B investors and solved the initial marketing problem, and eventually they became the market leader and beat the other competitors with the first mover advantage. So recently they're preparing for IPO, but because of the business scale, they're considering to acquire several, small device company to increase the top line. So we are structuring the M&A financing for them as well. So this is a very typical case that we basically grow the company together. Last but not the least, and also what we are working right now is we try to be a super connector as a bank, and this is why we are here. We try to go outside of China. We're striving to work with more innovative companies in Hong Kong, and also we try to bring more innovative companies back to China and connect them with, the China capital. With all of that, this is my sharing today. Thank you very much.
Very much, Ms. Ye. Please remain on stage. Professor Chan would like to deliver a souvenir to you as a token of appreciation. Thank you very much for your insightful sharing.